This PowerPoint presentation has been prepared for Swinburne Online by Ken Bridges and Matthew Brundell. Ken will take you through the financial report and its contents, while Matthew will look at the objectives of a financial report audit. Financial reports and their contents, presented by Ken Bridges. The financial report, also called the financial statements, demonstrate a company's financial position, balance sheet, financial performance, income statement, cash flows, and equity position of an entity over a specific time period. So what's in the financial report? At the top it lists the time period covered by that financial report, the balance sheet, the income statement, the cash flow statement, narratives or notes, and supporting documentation. The time period is usually listed at the top of the report or statement, listing the time period, which can be monthly, quarterly, or annually based. The balance sheet lists the assets and liabilities of a company. Assets include cash, investments, property, and other things owned by the company that have value. The assets are listed in order of liquidity. The most liquid assets, such as cash, are represented first. Liabilities are debts or obligations that the company owns to others. These include rent, payroll tax, loan payments, and money owed to other vendors and contractors. Note the difference between current liabilities and long-term liabilities. Current liabilities are things that will be paid off in a year. Long-term liabilities will take more than a year. The income statement shows how much money the company earned over a specific period and the money that was spent on earning that income. Sales or revenue reflects the amount of money the company made by providing its products or services before the expenses are deducted. Operating expenses include the cost of doing business, such as salaries, rent, insurance, and advertising. It also includes interest that was earned and paid. These amounts are then subtracted or added to the operating profit. Depreciation reflects the cost of an asset over the amount of time it can be used. The result gives a net profit or loss before income tax. Income tax is then deducted to give a net income. The cash flow statement shows the cash the company has available and tracks the money coming in and out of the company during a specific time period. The operating activities analyse how the company's cash was used in order to reach its net profit or loss. The investment activity shows the part of the cash flow from investments, income, or assets that were sold. The financing activities track what the company did to pay back or acquire things such as bank loans. Narrative or notes present information about the basis of preparation of the financial report and the specific accounting policies used in accordance with the ASB 101, paragraphs 108 to 115. KPI and financial performance. Financial reports are key to managing a company and judging its financial performance internally and against competitors. Financial reports contain all the information needed to produce the following ratios on the performance using profitability, efficiency, liquidity, and financial gearing ratios. I will now hand you over to Matthew Brundell to show the objectives of a financial report audit.
The development of auditing. Before the 19th century, records show that people were employed in ancient Egypt and Rome to review the work of tax collectors and estate managers. The emphasis was placed on detecting fraud and other irregularities. This approach was confirmed in a ruling in the famous case Kingston Cotton Mills Company, 1896, by Lord Justice Lopez. In his ruling, he defined an auditor's duty of care as follows: he is a watchdog, not a bloodhound. He is justified in believing tried servants of the company in whom confidence is placed by the company. He is entitled to assume that they are honest and rely upon their representations, provided he takes reasonable care. In the late 19th century, the concept changed and saw companies as separate legal entities. This led to the separation of ownership and directors from control, as they were no longer involved in the day-to-day decisions made by management. This required safeguards to protect the interests of owners. This in turn changed the school of thought from one of detection to prevention of error and fraud as the major objective of the auditor. What is an audit? An audit provides positive assurance that the accounts are considered to give a true and fair view of the organisation's finances. Audits help provide an outside look into the heart of the company's operations. Audits also allow potential investors to determine whether the company is a worthwhile investment. Audits can be undertaken internally by employees or heads of a specific department. They can also be completed externally by an outside firm or an independent auditor. Here we will elaborate more on external audits. The objective of an external audit by an independent authority is to ensure that all books of accounts are done in a fair manner and there is no misrepresentation or fraud that is being conducted. So why do we do audits? The demand for an independent financial report audit arises from the following conditions. 1. Conflict of interest. For example, management could present biased information in a financial report as it may impact on their bonus. 2. Consequence. When a user is contemplating using information to make decisions of significant consequence, the quality of that information is a major concern. 3. Complexity. The subject matter and the process by which the data is converted into information is complex, increasing the possibility of error and a need for high-level expertise to judge the quality of information. 4. Remoteness. The separation of owner and manager, and therefore the user and the preparer, prevents the user from assessing the quality of the information. To conclude, the objective of a financial report audit is to obtain reasonable assurance about whether the financial report as a whole is free from material misstatement, whether due to fraud or error, and to report on the financial report and communicate as required by the Australian auditing standards in accordance with the auditor's findings.
The information to compile this presentation was sourced from the following peer review articles and books.